Good morning. Welcome to Money Investment for All. In this video, we will see in detail the stock fundamentals, how to do stock fundamental analysis to buy cheap undervalued stocks to make huge profits. These are the various fundamentals we need to analyze before you buy the stocks. We will see in detail all these fundamentals. Okay. Disclaimer, please read this and follow it. Okay, what is face value? What is face value? It is the actual cost of stock. It is the original actual cost of stock as listed at the time of issue, at the time of IPO by the company, initial public offering. So it is the original cost, actual cost of the stock as listed by the company in the stock exchange at the very start. For example, face value of Bell equal to rupees 1. RVNL, Rail Vikas Nigam Limited, rupees 10. Bharat Electronics Limited, its face value is rupees 1. Okay. Now, what are the features of face value? We'll see now. It does not fluctuate. It is fixed price. Okay. It changes when there is a split in stock. For example, Cochin Shipyard last year announced bonus. Even CDSL this year announced bonus shares 1:1. Suppose you have 20 shares, then your shares now will become 40 shares. In such cases, the face value changes. It changes when stock split, example 1:1, then RVNL face value becomes 5. Okay. And this is also used at the time of dividend. This is used at the time of dividend. Dividend is announced as a percentage of the face value. Example, 100% dividend means rupees 10 rupees per share. If dividend is 50%, then they will give rupees 5 per share. Okay, now let us see what is book value. What do you mean by book value? It is the value of a company's share in the market on its books. It is the actual value of a company's share on its books. Okay. How it is obtained? Book value is net assets minus liabilities. Okay, net assets minus liabilities. Liabilities are, for example, the company is liable to pay salary. It is different from debt. Okay, now what is the formula used to calculate it? Book value equal to net assets value NAV minus liabilities divided by number of shares issued by the company. Okay. For example, book value of Bell Bharat Electronics Limited is equal to rupees 22.34, and its market value, its current market value is rupees 290. It helps if a stock is overpriced. In this case, you see it is overpriced. The stock is overpriced because it is the value of the company share, but in market its value is very, very high. Let us see there its significances. Okay, let us now see the important features of book value. 1. It indicates the company's value, actual value, and also it indicates the financial health of the company. Face value remains constant, whereas book value changes over time as assets liabilities changes, as it undergoes expansion. Okay, and how much amount you will get when the company is closed, okay, when the company is liquidated, when the company is dissolved. This is the amount, this is the book value, is the value of the company share. This is what they will give per share. Although its value is 290, they will give only 22.34 rupees per share. Okay, so it is the amount you will get, rupees 22.34 only per share if the company is closed or sold, liquidated. It helps to analyze if a stock is overpriced, underpriced, so we can decide whether to buy or not. Okay, in general, Bell is a good stock. The market value is most of the times greater than book value. Then investors believe that the company has excellent future. See, the company is growing, it has got a lot of growth, it has excellent future. So the investors believe that they will buy at a high price, market price. Okay, let us now see what is market value. It is nothing but market price of the company's share. It is the current market price of the stock quoted on stock exchange. For example, market value of Bell equal to rupees 290, the current market price. Okay. So what are the features of market value? It is highly volatile, changes every second, every minute. In short term, it is market price is very sensitive to market conditions, news, sentiments, FII selling. If FII is selling, the market price fall. Okay, these are all temporary only. In short term, these are all temporary, we have seen earlier. In long term, the market value is due to its performance only. Okay, market value, what is market price? It is a selling price or buying price. Okay, what is ROE? It stands for return on equity. Return on equity. Okay. So what is the formula to calculate ROE? For example, Bharat Electronics Limited has ROE value 24.41. Okay. So how this figure is obtained? Okay. And then is it good ROE value or bad ROE value? Can we invest in Bell company? We'll see now. Bharat Electronics Limited. So this is given by a formula, net income divided by net worth, or return on equity is equal to the ratio of net income to net worth of the company. Okay, now what is net income, and we'll also see what is net worth. That is very important. What is the net income of the company? What is the net worth of the company? We'll see now. See, what is net income? It is equal to, net income is equal to total sales. Okay, total sales minus cost of goods plus all expenses, administrative expenses and other expenses, and interest, whether company has borrowed loan, interest on loan, plus taxes to be paid. So what is the net income? It is equal to sales minus cost of all goods plus all expenses, including administrative and other expenses, interest on loan plus taxes. Okay. So next, what is net worth? Net worth is equal to, is also called shareholders equity. Shareholders equity. Equity means stock share only. Okay. Now equal to net worth of the company. What is the net worth of the company? Okay. It is equal to total assets okay, how much assets they have minus how much liabilities the company has. Okay, total assets, building, everything. Okay, and what are called liabilities? Liabilities equal to financial, it is different from debt. Okay, liabilities, you are liable to pay salaries to your workers, employee. So liabilities equal to financial obligations for paying salary, etc. Okay, now let us see what is good ROE value for a company. As I said earlier, Bell has got 24.4%. It is represented by percentage. Good ROE greater than 20%. Okay. For example, another company, Tata Trend, fashion textile company, its ROE equal to 25.66%. It is greater than 20%. Okay, so it is a good company we can invest in, and also it is efficient at generating profits from its equity. So this company is profitable company. The financial health is good. It is efficient at generating profits from its equity. Okay. Now, what is bad ROE? That is ROE less than 20%, less than 15%. A company has ROE less than 15%, then the company is not very profitable. Okay. So, according to market experts, ROE does not guarantee good returns. So, please note this. Good morning. Welcome to Money Investment. In this, we'll see top 5 high dividend public sector undertaking stocks. Okay. And what is dividend yield? What is dividend yield? And what are the companies that give, especially PSU stocks, that gave good returns in the last few years? Let us first see how is dividend amount calculated from dividend yield of a company. How is dividend amount calculated from dividend yield of a company? For example, Chennai Petroleum Corporation Limited, this is a company stock. It has given dividend yield 6.13. So in the fundamentals, you can see how much dividend they have given. Okay, for Schneider Electric, they have not given any dividend. Okay, so from the dividend yield, how much amount you will get, we'll first see. So what is dividend yield? It is expressed as a percentage of its stock price. It is expressed as a percentage of its stock price. That is, for example, let us consider CP, Chennai Petroleum Corporation Limited. It has given very good dividend in the last years, 6.13%, for example. So what is dividend? According to this definition, that is 6.13 divided by 100, that is percentage, into stock price. This is the dividend amount you will get. What is the dividend? How do you calculate the dividend amount? From dividend yield only they will tell. So from dividend yield, how the dividend is calculated? Using this formula. So for example, the stock price of CPCL is 897 rupees. Therefore, 6.13 divided by 100 into the dividend amount we get per share is equal to rupees 55 rupees. Okay, how dividend yield is calculated? From dividend yield, how much dividend amount we will be getting from the stock. Okay. Now there are four quarters. So each quarter they will give dividend. This is annual dividend yield. The given uh, dividend yield is annual dividend yield. Okay. So how dividend yield is calculated? You have stock price, okay, and dividend amount. You know the stock price of the Chennai Petro and what is the dividend amount, and then into 100, that gives the dividend yield in percentage. Let us see an example. See, the stock price of CPCL is 897 and its dividend amount 55 per share, okay, into 100, that is equal to 6.13%. Let us see now top 5 high dividend companies that gave huge dividends. Okay, one is Bharat Petroleum Corporation (BPCL). It has given very high dividend. Dividend yield is 9%. Next comes Indian Oil Corporation (IOC). It has also given very good dividend amount, that is equal to 7%. The third one is Hindustan Petroleum Corporation Limited. Its dividend yield is 7%. The fourth stock is Chennai Petroleum Corporation. It has given dividend yield 6.13. And the fifth one is Coal India mining sector. Its dividend is 6%. Okay, let us see what is PE ratio. What P stands for? Company's share price, stock price of the company. Okay. What E stands for? Earnings per share. How much earnings the company has earned per share. Okay. So it is defined as the ratio of a company's stock price to the company's earnings per share. It is given by this formula, P by E equal to share price and earnings per share. Okay, let us see with an example. For example, Zomato, its PE ratio is this much. How it is obtained, we'll see now. See, this is the earnings per share for Zomato as given in their report. Okay, this is the earnings per share. This is very small quantity, see, very much. What is the stock price? What is the share price? Rupees 271.75. Let us substitute in the formula to get PE ratio. This is the PE ratio. Now let us see whether the stock we can buy or we can buy. We'll see. What is good PE ratio? What is good PE ratio to buy a stock? For a good company, PE ratio should be equal to 20 to 25 range. But in this case, it is very high. In the case of Zomato, it is very high. So the stock is overvalued and expensive stock, according to market expert. From this fundamental, they will say the stock is overvalued and expensive stock because of this PE ratio is higher than 20 to 25. Okay. Okay. Now, PE ratio less than 20 to 25. What do you mean? That is, the stock is very cheap. It is undervalued stock. So, you can buy this stock. But, in contrary to this, Zomato stock doubled in a year. In most of the cases, it won't obey the fundamentals because sentimental, people's sentiments, it will follow the people's sentiments. So although some companies have high fundamentals, very good fundamental, PE ratio, good PE ratio, less PE ratio, but it is not doubled in a year. In this case, Zomato stock doubled because of people's sentiment. Okay, what is EPS? Earnings per share. It is equal to company's profit after tax divided by outstanding shares. In PE ratio, we have used EPS. What is EPS? How it is obtained? It is obtained by using this. It is the ratio of company's profit to the outstanding shares. Now, what is company's profit? You know how much the company has earned profit after tax, okay, after expenditure, everything. This is the company's profit. Now, what is outstanding shares? The company issues shares to investors. The total number of shares the company issue to investors, brokers, are called outstanding shares. And suppose EPS is very high, that means it is highly profitable company. It earns good profit, it gives good profit, and it is very high. EPS is also called profitability of the company. For example, in the case of Zomato, we have already considered this. Per share, it earns only 0.68. Okay, this has got very low earnings per share. Similarly, you can calculate for other companies and see if EPS is good, then the company earns more. It is using the capital for profitability. Okay, let us see what is debt to equity ratio, DE ratio. It is the debt a company has compared to its total assets. Okay, how much debt it has compared to its assets. How it is calculated? By using this formula, debt to equity equal to total liabilities or debts divided by total assets. Okay, total assets equal to assets minus liabilities. Okay, company assets and its liabilities, that is equal to total shareholders equity. Total assets is also called total shareholders equity. Okay, now let us compare P by E ratio, price per earnings. So share price divided by earnings per share. Okay, now return on equity. What is return on equity? This is similar to DE ratio. Here you put debt by total asset. Okay, here net income or profit by total asset. Net income divided by total assets. So it is inversely related, ROE and debt to equity. Okay, let us take few examples to show how much debt to equity for Mahindra and Mahindra. It is equal to 1.61. Trend, Tata Trend textile fashion company, it is 0.43. So Trend has got lower debt to equity ratio. Okay, now many people ask why banks and non-banking financial companies will have higher debt to equity ratio. For example, Power Finance Corporation, a public sector undertaking unit, 8.52. Cholamandalam, it is again a finance company, investment finance corporation, 6.86. They have greater debt to equity because the reason I have given, even banks I have not given here, banks will also have higher debt to equity ratio because they borrow, they get money through FD RD with interest rate 6.57%, and then they lend the borrowed money to the customers as home loan, bike loan, car loan, etc. to at 8 to 8.5%. Okay, so since they borrow money, they have more debts, so the DE ratio is higher for them. It is so natural for them, we need not worry about it. Okay, now let us demonstrate which is best debt to E ratio, debt to equity ratio, by comparing the two companies. Okay, let us call company A, okay, and the details are as follows, and let us take company B and the details are as follows. I will explain one by one. Company A needed 1 lakh rupees, okay, and they obtained through equity 50,000, and they borrowed from bank at interest rate debt 50,000. Okay, see company B, let us compare side by side. The company also needs 1 lakh rupees, but they collect all the money through equity shares 1 lakh. Okay, so now here debt equal to 0. This company B has 0 debt. Okay, now let us calculate debt to equity. So debt is 50,000 rupees divided by equity 50,000 rupees. Therefore, debt to equity ratio 1.01. Whereas for this company, debt is 0, therefore 0. D ratio 0. Okay, now company A makes profit rupees 20,000 rupees, and similarly company B also makes rupees 20,000 rupees. Now net profit, here net profit 20,000 rupees. Here, since the company A has borrowed loan, they need to pay interest at the rate of 8%. Therefore, 20,000 minus 4,000, that is equal to 16,000. Okay, so this is the net profit after subtracting debt and liabilities. Okay, this now ROE, let us calculate ROE. This is the profitability of the company. Profit ROE equal to profit divided by total equity shares. So 16,000 divided by equity 50,000. This comes 32%. It gives return of 32%. Whereas this company, you see, company B, profit 20,000 divided by, okay, 1 lakh rupees, 20% only. So company A, although it has got debt to equity ratio higher, okay, 1, this is just 0, but company A is better because of return on equity. Okay, so company B, although it has debt to equity ratio 0, it gives us return only 20%. Okay, based on the above, we can decide now what is good and bad debt to equity. Okay, so for a good company, debt to equity may be in the range 0 to 1.5. For a bad company which is not doing good, debt to equity ratio is greater than 1.5, that is 1.7, 1.8. It is financially not healthy, it is risky company. Okay, Thank you for watching. Please share and subscribe. Thank you again.